the speculator who has never been wiped out, who has never been forced to confront the abyss of his own failure, is a speculator who has not yet completed his education. For in this business, ruin is the great and unforgiving teacher. To be reduced to zero is not in itself a mark of failure. It is a rite of passage, a common and often necessary experience in the life of any man who dares to engage with the market on a serious level. The true test of a speculator's character is not whether he can avoid being knocked down, but whether he has the fortitude, the intelligence, and the courage to get back up. This is a clinical analysis of that very process. It is a deep dissection of the art of starting over, of the science of the comeback. And there is no greater case study in this art than the life of Jesse Livermore, a man who repeatedly climbed to the highest peaks of Wall Street, was cast down into the deepest valleys of ruin, and who, time and again, found the strength to begin the long, hard climb back to the top. His story is a testament to a profound and often overlooked truth, that losing everything is not the end of the game, but an opportunity to begin again, wiser and stronger than before. It is a lesson in the fact that a speculator's greatest asset is not his capital, but his knowledge of himself and of his own mistakes. The principles that guided his comebacks were not complex or secret. They were the simple, hard-won truths of the market, the very rules he had often violated to bring about his own downfall. His journey is the ultimate chronicle of failure and redemption. The foundational text for understanding this entire philosophy, the very soul of his operational thinking, was masterfully documented by Edwin Lefebvre. A link to his essential work, Reminiscences of a Stock Operator, now with a unique detailed chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This analysis is specially designed to make the timeless wisdom of the book accessible and powerfully relevant to the modern reader. The first of Livermore's great descents into the abyss was a lesson in the dangers of an untested system. He had begun his career as a boy genius, the boy plunger of the Boston bucket shops. In that simple, fast-moving environment, his method of pure tape reading was infallible. He had solved the game. He came to New York with a well-earned stake and an even greater supply of confidence, believing he could apply his bucket shop methods to the New York Stock Exchange with the same spectacular results. He could not. The conditions of the game were fundamentally different. The ticker was delayed. Executions were not instantaneous. The scale of the capital was vastly larger. His old system, so perfect for its original environment, was a useless and broken tool in this new, more complex arena. The market, in its impersonal way, proceeded to teach him this lesson. He was wiped out completely. His capital, the fruit of years of successful operation, was gone. This was his first experience of starting from zero. He was forced to borrow a small stake from a friend just to get by. The lesson was a profound one. A method is only as good as the conditions in which it operates. A speculator must be a student of changing conditions, and he must have the intellectual flexibility to adapt his methods accordingly. His first ruin was the price he paid for his own youthful rigidity. His second great downfall was far more complex and far more instructive. It was a ruin born not of inexperience, but of its opposite. The supreme arrogance and emotional recklessness that can follow a massive historic success. In the Great Panic of 1907, Livermore had cemented his legend. He had correctly anticipated the crash and, by selling the market short, had accumulated a fortune of several $1 million. He was the great bear of Wall Street, a man who had looked into the financial abyss and had emerged a king. It was this very success that laid the foundation for his next failure. A man who has just made a great fortune is in the most dangerous psychological state a speculator can experience. He begins to feel infallible. His respect for the market's inherent risk diminishes. He forgets that he is a student of the market and begins to see himself as its master. This hubris led him to the cotton market, where he intended to become the cotton king. He built a massive, dangerously large position, a line so great that it dwarfed even his most ambitious trades of the past. He was no longer speculating with caution. He was betting with the reckless abandon of a man who believed he could not lose. And crucially, he had allowed his judgment to be influenced by another man, a charismatic cotton expert named Percy Thomas. He had violated his own cardinal rule of relying only on his own study of the tape. When the cotton market began to turn against him, the tape gave him a clear and unambiguous signal to sell. A small loss at this point would have been a minor setback, but his ego and his loyalty to Thomas's bullish vision would not allow it. He held on. He began to hope. He was trapped by the psychological pressure of his own massive position. He was no longer thinking about preserving his capital. He was thinking only about being proven right. He wanted to win it back. This desire to win it back, to recoup a loss by pressing a bad bet, is one of the most powerful and destructive of all the emotional traps. It is a state of mind in which all scientific principles of speculation are abandoned in favor of a gambler's desperate hope. He not only held his losing position, he began to average down, throwing good money after bad, convinced that he could force the market to bend to his will. The result was a catastrophe. The cotton market collapsed, and he was wiped out once more, this time on a monumental scale. He lost his entire multi-million-dollar fortune and was plunged deep into debt. His second great start from zero was upon him. This failure was far more painful than the first, for it was not a result of ignorance, but a result of a willful and arrogant violation of the very rules he knew to be true. It is in the aftermath of such a devastating, self-inflicted loss that a man's character is truly tested. It is easy and it is common to blame the market, to blame bad luck, or to blame the advice of others. The amateur always finds an external cause for his failure. Livermore did not do this. This was the first and most important principle of his ability to recover. He never blamed the market. He knew the market was an impersonal force. He knew there was only one person responsible for his ruin, himself. This act of taking absolute personal responsibility is the cornerstone of all learning in speculation. A man who blames others for his mistakes is a man who is doomed to repeat them, for he has not learned the lesson. A man who blames himself is a man who has the power to diagnose his error and to ensure it never happens again. And so, in the quiet, painful years of his second financial exile, he began the hard work of self-analysis. He pored over his records. He dissected the cotton campaign, tracing his failure back to its root cause, his own ego, his own hope, and his decision to trust another man's opinion over the facts of the tape. He began the practical steps of recovery. He drastically reduced his personal expenses, a lesson in humility and respect for capital. He was forced to borrow a new, much smaller stake, a process that required him to swallow his immense pride. He was starting over, not as a king, but as a humble student once more. He had learned that the market does not forgive a lack of discipline. It does not care about a man's past successes. Each day is a new test, and the rules are always the same. His second ruin had forged these rules into his very soul. Another start-from-zero moment came not from a trading loss, but from an external event of historic proportions. The closure of the New York Stock Exchange in 1914 at the outbreak of the Great War. In the chaotic days leading up to the shutdown, the market was a whipsaw of rumors and fears. The amateur was gambling on the headlines, losing his capital on wild guesses about the political future. Livermore, having learned his lessons, largely stood aside. He saw that the conditions were not clear, that the tape was not telling a definite story, and in the absence of a clear signal, his rule was to do nothing. He was in cash, his capital preserved. The shutdown, which trapped and ruined countless other traders, left him unharmed, but it also left him, like everyone else, at a form of zero. He was a speculator with no market to speculate in. He was a great general with no battlefield. He did not, however, waste this time in idle frustration. He used the months of the closure for deep study and analysis. He knew that the war would fundamentally reshape the world and the market. he prepared his mind for the new game that would emerge when the exchange reopened. This period of forced inactivity was a powerful lesson in the strategic value of patience. Sometimes the most profitable thing a man can do is nothing at all. He must use the quiet times to study, to think, and to prepare for the next great, clear opportunity. The final and most tragic downfall came after his single greatest success. By applying all of his mature, hard-won principles, he correctly anticipated the great crash of 1929, and by shorting the market, accumulated his largest fortune, estimated at $100 million. He had reached the absolute pinnacle. He had conquered the game in a way no man had ever done before. And it was from this great height that his final, slow, and irreversible descent began. This last failure was not the result of a single bad trade or a single violation of his rules. It was a slow, grinding disintegration of the man himself. The reasons were complex and deeply personal. His private life was in turmoil. He went through a series of difficult and costly divorces. He was beset by personal tragedies that would have broken any man. The immense, almost unimaginable pressure of managing such a vast fortune began to take its toll. The market, too, was changing. The creation of the SEC and new government regulations had altered the freewheeling game that he had mastered. The old rules of manipulation and pool operations no longer applied in the same way. But the ultimate cause of his final downfall was a form of mental and spiritual exhaustion. The great game of speculation, when played at the highest level, is a marathon of immense psychological pressure. It is a constant battle against the powerful elemental forces of one's own human nature. After nearly 40 years of this intense, non-stop warfare, a man's mental and emotional capital can become depleted. His nerve, his confidence, his very will to continue the fight can begin to erode. He began to make uncharacteristic mistakes. He invested in ventures outside his field of expertise. He lost his legendary feel for the tape. The clear, cold, objective mind of the master speculator became clouded by the fog of his own inner turmoil. By the mid-1930s, he was, for the third and final time, bankrupt. This time there was to be no comeback. The man was older, the market was different, and his own inner fire had been extinguished. What, then, is the ultimate lesson from this cycle of ruin and rebirth? It is that the game of speculation is, first and foremost, a test of character. It is a man's own weaknesses, his own emotional and psychological flaws, that are his greatest and most persistent enemy. Livermore proved that any man can lose his capital. It is a part of the game. The true mark of a speculator is not his ability to avoid these losses, but his ability to endure them, to learn from them, and to begin again. To start from zero is not a disgrace. It is an opportunity. It is a chance to shed the old bad habits, to correct the flawed thinking, and to begin a new campaign with a clean slate and the invaluable wisdom that has been paid for with the price of defeat. The market is a great marathon, not a sprint. The man who is at the bottom today can, with the right application of principles, be at the top tomorrow. The market is always there, always offering new opportunities. The final and most important question is not whether a speculator will fall. He will. The question is whether he has the character to use the hard rock of his own failures as the foundation upon which he will build his next and greatest victory. The first, most difficult and most essential step on the long road back from zero is, therefore, a profound and unflinching act of self-analysis. The speculator must look into the unflinching mirror of his own results and say, with absolute conviction, "The market was not wrong. My judgment was wrong." He must understand that the market is an impersonal and infallible machine. It registers the facts of supply and demand. It has no opinion, no malice, and no favorites. A loss is not a punishment inflicted by the market. It is the market's impartial verdict on a flawed speculative opinion. By accepting this responsibility, the speculator takes the first step in reclaiming his power. He moves from the position of a helpless victim to that of a scientist who has just witnessed a failed experiment. His task now is not to curse the laws of nature, but to analyze his procedure to discover the source of his error. He must recognize that his loss was the result of a specific mistake, a violation of a sound principle of speculation. Perhaps he was ignorant of the principle. Perhaps he knew it, but was too weak in character to follow it. The reason does not matter. The fault is his and his alone. This act of taking responsibility is a painful one. It is a blow to the ego. But it is the necessary and cleansing fire through which every man must pass before he can be reborn as a true professional. Until a man can look at his own foolishness without flinching, he is not ready to return to the game. With the correct mental foundation now laid, the second step is a practical and immediate one, the ruthless protection of what little capital remains. A speculator's capital is his lifeblood. It is his ammunition, his inventory, the tool of his trade. Without it, he is out of the business. The man who has suffered a great loss must immediately and drastically reduce his personal expenditures. He must abandon the lifestyle of the successful speculator he once was and adopt the frugal habits of a man who is starting over. He must treat every remaining dollar with a kind of sacred reverence. He cannot afford to waste a single cent on non-essentials. The desire to keep up appearances is a form of ego that a broken speculator cannot afford. His one and only focus must be the preservation of his speculative ammunition. A man with a single dollar in his pocket is still a speculator. A man with zero is a former speculator. This period of forced frugality is a powerful and necessary form of discipline. It is a constant daily reminder of the cost of his past mistakes. It rebuilds his respect for money, a respect that was likely lost during the heady days of his previous success. It is a humbling process, but it is the foundation of a sounder and more permanent future success. The man who has learned to live on little is a man who is no longer a slave to the need for constant profits. He can afford to be patient. The third step is to forge a new and unbreakable constitution for his future operations. Before he makes another trade, he must establish a set of definite and inviolable rules for the management of his risk. He has just learned in the most brutal way possible what happens to the man who trades without such rules. He must determine in the cold light of reason the absolute maximum percentage of his total capital that he is willing to risk on any single speculative idea. This figure should be a small one, perhaps no more than 1 or 2% of his total stake. This is his insurance premium against his own fallibility. It is the mathematical guarantee that no single error in judgment can ever again have the power to wipe him out. He must then recommit himself to the ironclad rule of the stop-loss. He must decide, based on his reading of the tape and the character of the stock, exactly where his opinion is proven wrong, and he must place his stop-loss at that point with the unwavering resolve to honor it without question or hesitation. These rules, once established, are not mere suggestions. They are the supreme law of his new business. To violate them even once is to begin the journey back to ruin. The fourth step is the return to the market itself. But this return must be a cautious, humble, and scientific one. The speculator who has been broken cannot return with the same bold and aggressive posture he once had. His nerve has been shaken, and his confidence must be rebuilt, slowly and carefully. Therefore, he must begin with a small stake. His first trades upon his return should be for a deliberately and almost absurdly small number of shares. The purpose of these initial trades is not to make a great deal of money. The purpose is twofold. First, it is to test his reforged discipline. Can he follow his new rules under the pressure of a real market? Can he cut a small loss without hesitation? Can he sit with a small profit without fear? Second, it is to rebuild his confidence. A series of small, successful trades executed perfectly according to his plan will do more to heal a broken nerve than any amount of abstract study. It is the proof to his own mind that he has learned his lesson and is once again capable of operating correctly. To return to the market with a large position, under the pressure of needing to make a big score, is a fatal error. It invites the old emotional demons of fear and greed back into the game. The comeback must begin small, with the single, patient goal of trading correctly, not of trading for a profit. This leads directly to the fifth, and most psychologically difficult step. The absolute and total conquest of the urge to win it back quickly. This is the great enemy of the comeback. It is the gambler's instinct, the desperate desire to erase the memory of the great loss with a single, heroic, and spectacularly profitable trade. This urge is born of a wounded ego. It is a desire not for money, but for redemption. The speculator feels that he must prove to the market and to himself that his last failure was a fluke, that he is still the master of the game. This is a dangerous and self-destructive state of mind. The market does not care about a man's need for redemption. It is an impersonal machine. The path back from zero is not a sprint. It is a long, slow, and methodical marathon. It is a journey of 1,000 small, correct steps. The speculator must, as a matter of conscious discipline, completely abandon the thought of his past losses. He must treat his new, small stake as if it were his first and only stake. His goal is not to make back the 1,000,000 he lost, but to correctly manage the 1,000 he now has. If he can do this, if he can focus only on the present and on the perfect execution of his sound principles, the profits will, in time, take care of themselves. The man who tries to get rich quick for the second time is a man who is destined to get broke for the second time. The sixth step in the process of rebirth is the transformation of failure into education. The amateur repeats his mistakes. The professional learns from them. The speculator who has been wiped out must become a ruthless and objective student of his own past folians. He must keep a detailed journal, a logbook of his trades, particularly his losing trades. He must perform an honest and unflinching autopsy on each one. He must ask, what was my original premise? At what point was it proven wrong? Why did I fail to act on that evidence? Was the mistake a result of ignorance, a flaw in his analysis? Or was it a result of weakness, a violation of a rule he knew to be correct? He must be brutally honest with himself. A loss that does not result in the creation of a new written-down rule or the reinforcement of an old one is a completely wasted loss. It is a tuition fee paid to the market for an education that the student has refused to receive. The professional speculator uses the painful memory of his losses as the foundation upon which he builds his future victories. The seventh step is the re-enthronement of the one quality that makes all the others possible. It is the master principle of the professional speculator's mind. It is the habit of maintaining absolute discipline over one's own emotions. The great battle of speculation is not fought against the market, but against the powerful, primal, and often destructive human instincts of hope, fear, and greed. A man who is a slave to these emotions is a man who can never hope to succeed. Discipline is the only weapon that can conquer these internal enemies. It is not a feeling. It is a conscious and willed act. It is the act of subordinating one's own emotional impulses to a predetermined, logical, and proven system of rules. The speculator who is starting from zero must be a fanatic for discipline. He knows from the painful evidence of his own empty pockets what happens when discipline is allowed to lapse. His new career must be a monument to this one, great saving virtue. It is in this moment of accepting a loss that a trader's discipline is most severely tested. The pain of being wrong can be immense. It is for this reason that a constant study of these principles is not a luxury, but a necessity for survival. A return to this channel, to this video and others, especially after a series of unsuccessful trades, serves as a vital recalibration of the professional mindset. The eighth and final step of the comeback plan is the cultivation of the great virtue of patience. This is the discipline of trading only when there is a clear and definite advantage, when the market's own action aligns perfectly with one's own strategic principles. The amateur, and especially the amateur who is trying to win back a loss, is desperate for action. He will trade on minor fluctuations, on weak signals, on pure hope. He is impatient, and the market will punish his impatience. The professional speculator, the man who is rebuilding his fortune from zero, knows that he cannot afford to be impatient. His capital is too precious. He must wait, with the calm vigilance of a sniper, for the one, perfect high-probability opportunity to present itself. He knows that such opportunities are rare. He may have to sit in cash for weeks or even months watching the market, studying the tape, and doing nothing at all. This period of inaction is the most difficult and the most profitable work he does. He trades only when the line of least resistance is clear, when a leading stock has reached its pivotal point, when the volume is confirming the move, and when the general market is in harmony. He trades only when the probabilities are overwhelmingly stacked in his favor. This, then, is the complete blueprint for a comeback. It is the method for starting from zero. It begins not with a market tip, but with an act of profound self-analysis and the acceptance of personal responsibility. It continues with the practical defensive acts of protecting one's capital, cutting one's expenses, and defining one's rules of risk. It then moves to the cautious, humble, and scientific re-entry into the market, starting with a small stake, with the sole purpose of rebuilding confidence and testing one's own reforged discipline. It requires the absolute conquest of the gambler's urge to win it all back at once, and its replacement with the professional's patient, methodical, one-step-at-a-time approach. It demands that every past mistake be transformed into a future lesson, that the speculator become a ruthless student of his own failures. And it culminates in a state of mind that is the hallmark of the master, a mind that is ruled by discipline, not emotion, and a method that is based on patience, not on a constant need for action. The journey from zero is the most difficult a speculator can ever make, but it is also the most educational. The man who has been broken by the market and has had the character to rebuild himself according to these sound principles is a man who will not easily be broken again. He has been through the fire and he has emerged as tempered steel. He knows himself, he knows his enemy, and he knows the rules of the game. He is at last a true professional. Modern stock speculation is dominated by the visual analysis of charts, replete with indicators, trend lines, and complex patterns. It is a common assumption that mastery of these tools is essential for success. Yet Jesse Livermore, one of the most successful speculators in history, found charts to be altogether too confusing. He relied not on visual aids, but on a direct interpretation of the market's raw data as it was printed on the ticker tape. His method was to perceive what can be called an invisible trend line, a line of least resistance established not by drawing on a graph, but by understanding the underlying forces of price, volume, and time. This is the method of reading momentum directly from its source. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The foundation of Jesse Livermore's method was a return to the first principle of market information, the ticker tape itself. While modern traders build their strategies around the retrospective images presented on charts, Livermore held a deep-seated skepticism towards them. He stated, "Personally, charts have never appealed to me. I think they are altogether too confusing." This was not the statement of a man who failed to understand them. It was the conclusion of a master who had found a more direct and truthful source. For him, the chart was a delayed, second-hand interpretation of events. The tape, in contrast, was the event itself, unfolding in real time. It was the best little friend he had, a direct line to the market's pulse. His entire career was a testament to the idea that all the information a speculator truly needs is contained in the simple, ceaseless flow of prices and volumes. He believed that the tape does not concern itself with the why and wherefore, it simply states what is. He did not ask the tape for reasons when he was 14, and he did not ask it when he was 40. The reason for a stock's movement might not be known for days or weeks, but the speculator's business is with the now, not the tomorrow. The tape provided that immediate truth. This focus on the tape led him to develop a unique perception of the market. He did not see stocks as entries on a balance sheet or as abstract corporate entities. He saw them as living things, with distinct personalities and habits. Stocks, like individuals, have character and personality, he wrote. Some are high-strung, nervous, and jumpy. Others are forthright, direct, logical. One comes to know and respect individual securities. This personification was not a poetic flourish. It was a practical method of analysis. It meant that a speculator could, through careful observation, learn the predictable behaviors of a stock under various conditions. This was the genesis of his dope sheets, which he carried not on paper but in his mind. He looked for stocks to run on form. He was not looking for tips or inside information. He was studying behavior. He understood that speculation is as old as the hills, and whatever happens in the stock market today has happened before and will happen again. His phenomenal memory for figures was not just a natural gift. It was a cultivated tool for recognizing these repeating patterns of behavior. He was not just seeing numbers, he was seeing the story of a battle between buyers and sellers, and the tape was his telescope. To understand how Livermore read the invisible trend line without charts, one must dissect his method into its three core components, the trinity of his tape-reading art: price action, volume, and the time element. The first and most fundamental of these was price action. Livermore's entire approach was built on the principle of trading in the direction of the prevailing momentum. This led him to a practice that is deeply counterintuitive for the average speculator. He always bought a rising stock and sold a falling one. He never bought a stock simply because it had experienced a significant decline from its previous high. He warned, never buy a stock because it has had a big decline from its previous high. The likelihood is that the decline is based on a very good reason. An amateur sees a stock that has fallen as cheap, but Livermore saw it as demonstrating weakness. He understood that the line of least resistance was downward, and fighting that momentum was a fool's errand. Conversely, he had no fear of buying a stock that was making a new high, a move that often paralyzes novice traders with fears of buying at the top. He stated, "In my method of trading, when I see by my records that an upward trend is in progress, I become a buyer as soon as a stock makes a new high on its movement, after having had a normal reaction." This was not about buying high. It was about buying right. A new high was the market's own confirmation that the forces of demand were overpowering supply, that the path of least resistance was upward. To buy at that moment was to align oneself with the dominant force. The price itself was secondary to the momentum it represented. Remember that stocks are never too high for you to begin buying or too low to begin selling. The focus was always on the direction of the movement, not the absolute price level. The invisible trend line for him was drawn by the succession of new highs in an uptrend or new lows in a downtrend. The second critical element of his analysis was volume. Price action alone was insufficient. It had to be validated by the force or lack thereof behind it. Volume was the measure of that force. A stock advancing into new high ground on heavy increasing volume was a sign of powerful, genuine demand. It was a confirmation that large interests were accumulating the stock and that the upward move had energy. Conversely, a price that drifted higher on light, anemic volume was a sign of weakness, a move that lacked conviction, and was likely to fail. However, Livermore's true mastery of volume analysis was most evident in his interpretation of reactions or pullbacks within a trend. He made a crucial distinction between what he called a normal reaction and an abnormal reaction. A normal reaction was a healthy and expected part of any sustained trend. In a bull market, a stock would advance for a period on high volume, and then it would inevitably pull back. Livermore taught that if this pullback occurred on much less volume than the preceding advance, it was a normal and constructive sign. It indicated that the selling was not aggressive, that holders of the stock were not rushing to unload. It was the market simply catching its breath, consolidating its gains before the next push higher. Never be afraid of the normal movement, he advised. An abnormal reaction, however, was a significant danger signal. This could manifest in several ways. It might be a sudden, sharp sell-off on a spike in volume, indicating that large holders were now aggressively distributing their stock. Or it could be a day of extreme volatility where a stock opens strong, makes a new high, and then reverses violently to close at or near its low for the day, all on heavy turnover. This told him that the character of the market had fundamentally changed. The balance of power had shifted from the buyers to the sellers. The invisible trend line was showing signs of breaking. Volume provided the context. It gave meaning to the price movements and was an indispensable tool for gauging the health and sustainability of a trend. The third and most subtle element, the one that Livermore himself claimed unlocked the true potential of his method, was the time element. It was not until I began to take into consideration the time element that my records really became useful in helping me to anticipate coming movements of importance, he wrote. My records began to talk to me. This was not about using a stopwatch to time minor fluctuations. It was about understanding the rhythm and tempo of a healthy trend. A strong, valid trend has a sense of urgency. It is impatient. It wants to continue its advance. He began to pay close attention to the duration of reactions. In a powerful uptrend, a stock might pull back for a day or two, but it should then quickly recover and push on to new highs. If, instead, a stock went stale after a reaction, if it moved sideways in a narrow range for an extended period without resuming its advance, it was a warning sign. It suggested that the buying power that had previously driven the stock higher was now exhausted. The momentum was fading. The time element was a test of the trend's vitality. He advised traders to familiarize yourself with a stock or different groups of stocks, and if you figure the time element correctly in conjunction with your records, sooner or later you will be able to determine when a major move is due. Time was the final arbiter. A stock that acted correctly in terms of price and volume but failed the test of time was a suspect. The invisible trend line was defined not just by direction and force, but also by persistence and rhythm. This intuitive method of synthesizing price, volume, and time to feel the market's true intention was Livermore's unique art. It was a skill honed over decades of intense, singular focus. While he developed this feel through instinct and observation, another market giant of his era, Richard Wyckoff, was independently working to codify these very same principles into a structured analytical science. Wyckoff's three fundamental laws, the law of supply and demand, the law of cause and effect, and the law of effort versus result, are in essence the scientific explanation for what Livermore was seeing on the tape. Wyckoff's analysis of price spreads, volume, and the time it takes for movements to occur provides a logical framework for reading the market's intentions. He taught traders to see the actions of large, informed operators, the composite man, through the patterns they left on the tape. If Livermore was the artist who could feel the pulse of the market, Wyckoff was the scientist who dissected its anatomy. For anyone looking to move beyond intuition and build a logical, repeatable methodology based on these timeless principles, the Richard Wyckoff Trading Methods channel is an essential resource. It provides a systematic education in reading the tape with the same depth and clarity as the masters. You can find a link in the description. In the end, Livermore's approach was a holistic one. He did not rely on a single indicator or a rigid pattern. He was in a constant state of diagnosis, observing the market's behavior through the lenses of price, volume, and time. He was not looking at a static picture on a chart. He was engaged in a dynamic conversation with the tape. He listened for its confirmations, heeded its warnings, and respected its final authority. He was not trying to impose his will on the market, but to understand its will and align himself with it. This was how he perceived the invisible trend line. It was not a line drawn on a chart, but a force felt in the heart of the market, a force he learned to read with unparalleled mastery. Recognizing the behavior of the market through the trinity of price, volume, and time was the foundational skill that separated Jesse Livermore from the ordinary trader. However, possessing the ability to read the language of the tape is one thing. Knowing how to use that language to formulate a coherent and profitable trading campaign is another entirely. The next stage of his evolution was the development of a strategic framework for a single purpose: to identify and capture the heart of the great market movements. This strategy was not based on prediction or forecasting. It was built upon a single, powerful principle that governed his every action: the concept of the line of least resistance. He stated, "Prices, like everything else, move along the line of least resistance. They will do whatever comes easiest." The entire object of his analysis was to determine this path. His task was not to guess where the path would lead, but to wait patiently until the path defined itself, and then to follow it with conviction. This concept is fundamental. The line of least resistance is not a mystical force. It is the simple expression of the imbalance between supply and demand. When buying pressure is stronger than selling pressure, the line of least resistance is upward. When selling is stronger than buying, the line is downward. When the two forces are in equilibrium, the market moves sideways in a narrow range. The amateur trader exhausts his capital and his mental energy fighting these forces, buying into declines and selling into advances. The master speculator waits until the battle between buyers and sellers resolves itself. He waits for the market to declare its intention. The thing to do, Livermore advised, is to watch the market, read the tape to determine the limits of the get-nowhere prices, and make up your mind that you will not take an interest until the price breaks through the limit in either direction. That breakout was the signal that the line of least resistance had been established. That was his signal to get busy. To identify this critical moment, he developed and relied upon a set of specific practical tools. His first tool was the analysis of group behavior. Livermore observed a simple but profound market truth. Stocks do not move in a vacuum. They move in groups, sectors, and industries. "We know that all stocks do not move one way together," he noted, "but that all the stocks of a group will move up in a bull market and down in a bear market." This led to a critical trading principle: follow the leaders. He always confined his studies to the prominent active stocks of the day, understanding that if you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. When a true bull market was underway, the leading stocks in the leading groups would be the first to advance, and their movements would be the most powerful. This observation gave him an invaluable diagnostic tool for identifying weakness. The common practice among the public and many so-called professionals is to look for the laggards in a strong group. The reasoning seems logical. If the leading motor stocks have advanced 20 points, the one motor stock that has not moved must be cheap and is due for a rise. Livermore saw this as a fatal error. He wrote, "Experiences had taught me to beware of buying a stock that refuses to follow the group leader. A stock that remains dormant while its peers are advancing is not a bargain. It is a patient demonstrating a severe underlying illness. Its failure to respond to the bullish news affecting its entire industry is a clear signal that there is something profoundly wrong with it. When the men who ought to want a stock do not want it, why should I want it?" he reasoned. The absence of inside buying, or worse, the presence of disguised inside selling, was the only explanation. The invisible trend line for that stock was not upward, and no amount of hope could change that fact. The tape plainly told him there was something wrong, and that was all the information he needed to stay away, or even to sell the stock short. His second, and perhaps most famous tool for identifying the start of a major move was the pivotal point. This was the specific price level that acted as his ultimate timing signal. He wrote, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." He stated this was because he commenced his play at the exact psychological time at the very beginning of a move. A pivotal point was a level where, if crossed, the line of least resistance would be undeniably established. He identified several types of these points through his meticulous record-keeping. The most straightforward were the major price barriers: 50, 100, 200, and 300. He observed that a fast and straight movement almost invariably occurred after such points were passed. These levels acted as psychological dams. Once breached, the pent-up market energy was released in a powerful surge. Another critical type of pivotal point was the breaking of a new high for a movement, or a new all-time high. Let us say that a new stock has been listed in the last 2 or 3 years and its high was 20, he explained. If something favorable happens in connection with the company and the stock starts upward, usually it is a safe play to buy the minute it touches a brand new high. For Livermore, this was the moment of least resistance. All the sellers who had been trapped at lower prices were out, and the stock was entering clear territory. But a pivotal point was not a blind signal to buy. The character of the action after the point was crossed was the final confirmation. The advance had to be immediate and forceful. As he demonstrated with Anaconda, when the stock crossed 300 but failed to continue its advance with vitality, it plainly was flashing the danger signal. The action of the stock right above 300 clearly showed it had become a dangerous stock to own. The pivotal point gave him the entry, but the subsequent action of the tape confirmed whether he should stay in. It was a 2-part test that required both patience to wait for the signal and alertness to interpret the follow-through. The third tool in his arsenal was the method of market testing, which was inextricably linked to his principle of pyramiding. Once a pivotal point was crossed and he decided to act, he never took his entire position at once. This, he believed, was a wrong and dangerous practice. Instead, he would initiate a small exploratory trade. Let us suppose that you want to buy 500 shares of a stock. Start by buying 100 shares, he instructed. This initial trade was a probe, a question asked of the market. The market's answer came in the form of an immediate profit or loss. He stated as one of his primary rules. It is foolhardy to make a second trade if your first trade shows you a loss. Never average losses. If his first purchase showed a loss, it meant his timing was wrong, and the only sensible action was to close the trade and take the small loss. If, however, the first trade showed an immediate profit, it was the market's confirmation that his timing was correct and that he was aligned with the line of least resistance. Only then would he make his second commitment. Crucially, he insisted that each succeeding purchase must be at a higher price than the previous one. This practice of buying on a scale up is one of his most important but widely ignored principles. It served as a continuous validation of his position. The fact that his trades consistently showed him a profit was his proof that he was right. This method ensures that a speculator's largest positions are held only when the market is strongly confirming his judgment. It keeps him out of trouble when his initial timing is off and forces him to be most aggressive when he is most correct. It is the scientific application of the old trading axiom, cut your losses short and let your profits run. These 3 tools, analyzing group behavior, identifying pivotal points, and testing the market with pyramiding trades, formed the mechanical basis of Livermore's strategy for capturing the big swing. But underpinning all of them was his core philosophy. The speculator must be a servant to the market, not its master. He must react to the market's evidence, not try to impose his own predictions upon it. He stated, "A man may form an opinion regarding a certain stock, and eventually be correct in his opinion, but will lose money by acting on his opinion too soon." The market itself is the final arbiter, He learned to banish wishful thinking and to respect the message of the tape above all else. His own opinions were worthless until validated by the market's action. Markets are never wrong, opinions often are, was the foundational truth upon which he built his fortune. His system was not a method for predicting the future. It was a method for recognizing the present with unflinching clarity. He waited for the invisible trend line to reveal itself, and only then, with the full force of the market's momentum behind him, did he act. The mastery of the principles of momentum and the precise identification of the line of least resistance constitute the mechanical framework for successful speculation. A trader can possess a perfect understanding of group behavior, pinpoint pivotal points with unerring accuracy, and execute his market tests flawlessly. Yet with all this technical knowledge, he can still fail. The reason is that the most formidable opponent a speculator ever faces is not the market itself, but his own human nature. The final and most difficult lesson in the art of speculation is the conquest of emotion. Jesse Livermore learned through years of painful and costly experience that the ultimate battle is waged not on the ticker tape, but within the confines of the speculator's own mind. The development of psychological discipline is the final and most crucial step in holding the invisible trend line. The central problem for every trader is the constant internal war between two powerful and primal emotions, hope and fear. In everyday life, these emotions serve essential purposes, but in the world of speculation, they become the speculator's deadliest enemies. The tragic irony, as Livermore observed, is that the average man applies these emotions in the exact reverse of how they should be used in the market. When a trade goes against him, he is filled with hope. He buys a stock at a certain price and it begins to decline. Instead of recognizing that his initial judgment was flawed, he hopes that the decline is temporary. He hopes for a rally that will bring the price back to his entry point so he can escape without a loss. This hope is a form of financial anesthetic. It numbs him to the pain of his mistake and keeps him anchored to a losing position as it deteriorates. Livermore learned to reverse this instinct. When a trade went against him, he did not hope. He felt a sharp, immediate fear. He feared that the small loss he was facing could quickly metastasize into a much larger, capital-destroying one. This fear was not a paralyzing emotion. It was a call to action. It was the signal to close the trade, accept the small loss, and preserve his capital for a more sound opportunity. Conversely, when a trade moves in a speculator's favor, he is consumed by fear. He has a small, fragile profit, and he is terrified that the next market fluctuation will take it away from him. This fear compels him to sell too soon, to snatch a meager profit and abandon a position that may have been the start of a major fortune-building move. He is afraid of losing what he has just gained. Livermore understood that this was the moment for hope. A profit, however small, was the market's own confirmation that his initial judgment was correct. It was the evidence that he was aligned with the line of least resistance. This was the time to be courageous, to have faith in his analysis, and to hope that his small profit would grow into a very large one. This deliberate and conscious reversal of his natural emotional responses, fearing his losses and being hopeful about his profits, was the psychological key that unlocked his ability to ride the great market swings. It was, he confessed, one of the hardest things to learn, but it was the only way to make the truly big money. This psychological discipline found its ultimate expression in his most famous principle, sitting tight. After spending years in Wall Street and after making and losing millions of dollars, he came to a profound conclusion. It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight. This is one of the most misunderstood concepts in speculation. Sitting tight is not a passive act of laziness or inattention. It is an act of profound, disciplined patience. It is the ability to hold a correct position through all the minor, nerve-wracking fluctuations until the fundamental reasons for the position have changed. He observed countless traders who were correct on the market at exactly the right time. They would buy at the very beginning of a bull market or sell at the start of a bear market. Yet they made no real money. The reason was simple. They could not sit tight. They would be shaken out by a small reaction or tempted to take a quick profit, thereby losing their position and missing the heart of the major move. Men who can both be right and sit tight are uncommon. To achieve this level of fortitude, Livermore had to learn to differentiate between the market's meaningful signals and its random noise. He understood that no market moves in a straight line. Even the most powerful trend is punctuated by counter-movements. His analysis of price and volume gave him the tool to distinguish between a normal reaction and a genuine change in trend. A normal reaction, as he defined it, was a pullback on diminished volume. It was the healthy, expected rhythm of a market in motion. He learned to endure these reactions without being shaken. His initial analysis, confirmed by the market's action at the pivotal point, was his anchor. As long as the stock's behavior remained consistent with that of a healthy trend, he would not be swayed by these temporary dips. He had a backlog of profit from his pyramiding strategy, which provided a psychological buffer. This allowed him to view these reactions not as threats, but as a normal part of the process. This discipline was built on another core rule: do not argue with the tape. While he learned to ignore the noise of normal reactions, he also trained himself to act instantly and without hesitation when the tape sent a clear signal that the invisible trend line was changing direction. This signal often came in the form of an abnormal reaction, a sharp break on heavy volume, a failure to rally after a decline, or a stock's refusal to follow its group. When he saw these signs, he did not wait for confirmation from newspapers or seek opinions from others. The tape had spoken, and its verdict was final. The reasons could wait, but the action could not. This immediate response was the other side of the sitting tight coin. His patience in a winning trade was matched only by his impatience with a losing one, or one that was beginning to turn against him. He knew that the moment he began to argue with the tape, the moment he started to substitute his own hopes for the market's clear evidence, he was lost. The ability to read the invisible trend line, therefore, was not merely a technical skill. It was a holistic discipline, a synthesis of acute market observation and profound self-control. It was the understanding that the market is a reflection of human psychology, and to master the market, one must first master oneself. This journey from a boy in a bucket shop to a Wall Street legend, this evolution from a gambler to a master speculator, is a story of intellectual and psychological struggle. It is a story that every person who seeks to profit from the markets must understand, not just as a history lesson, but as a practical guide. There is no more powerful or intimate account of this journey than the one captured by Edwin Lefebvre in his timeless classic, Reminiscences of a Stock Operator. The book is more than a biography. It is a masterclass in the mind of a trader. It allows you to stand beside Livermore, to witness his thought process, to feel his internal battles, and to learn his hard-won lessons without paying the multi-million-dollar price he did. It is a guide to developing that sixth sense for the market. However, to translate the profound wisdom of a book written a century ago into an actionable edge in today's complex, high-speed markets requires a key. That key is the detailed, chapter-by-chapter analysis by Max Davidson. It is not a simple summary. It is a deep analytical dissection of the strategies, the psychology, and the timeless principles that made Livermore a titan. It deciphers his methods, illuminates his psychological insights, and forges them into a practical framework for the modern trader. For anyone serious about moving beyond the surface and truly understanding the art of speculation, the link in the description is your next step. The ghost of a missed opportunity haunts every trader who has ever watched a fortune on paper evaporate into the thin air of market reality. It is a universal pain, the agonizing question that echoes in the silent aftermath of a catastrophic loss. Why didn't I sell? For every 1,000 men who can expertly predict a market's rise, perhaps only one possesses the cold, calculated wisdom to know the precise moment to exit. Jesse Livermore was that one man. His ability to liquidate his positions at the pinnacle of a move, just as the final wave of public euphoria crested, was not magic, nor was it a simple hunch. It was a science, a discipline built upon a foundation of immutable rules, rules that transformed him from a boy plunger into a Wall Street legend, and rules that, once understood, can serve as the ultimate shield against financial ruin. These principles were not born in a classroom or from abstract theory. They were forged in the crucible of devastating losses and spectacular victories. They are the architecture of a mindset that conquered the most formidable of all adversaries, the trader's own human nature. To understand Livermore's method of selling is to understand the very essence of market dynamics, for he did not merely react to the market, he anticipated its soul. He recognized that the art of speculation was not a game of hope, but a business of probabilities, governed by the unwavering law of supply and demand, and dictated by the single incorruptible voice of the ticker tape. What follows is not a collection of vague aphorisms, but a dissection of the 6 foundational pillars of Livermore's exit strategy. These are the mechanical, psychological, and strategic triggers that told him, with chilling accuracy, when the end of a move was not just near, but had arrived. Mastering them requires more than memory. It demands a radical shift in perspective, a commitment to a discipline so rigid it feels unnatural. Yet for those who embrace it, it offers the key to unlocking consistent profitability and, more importantly, to surviving the game. The principles are as relevant today as they were a century ago, for while the players and the stocks may change, the game itself, driven by greed and fear, remains eternal. For those who wish to delve deeper into the mind of this master speculator and understand the full context of his journey, a unique resource has been prepared. A link to Edwin Lefebvre's timeless classic, Reminiscences of a Stock Operator, is provided in the description below. This version is accompanied by a new, detailed chapter-by-chapter analysis from Max Davidson, an analysis specifically designed to translate Livermore's century-old wisdom for the modern reader, making his lessons more accessible and actionable than ever before. This guide is an invaluable companion for anyone serious about mastering the market. The first and most fundamental rule in Livermore's arsenal was deceptively simple. Yet it is the one most universally violated by traders, both novice and seasoned. He operated under the unshakable belief that the first loss is always the smallest and best loss. This wasn't just a clever saying, it was a non-negotiable law of financial survival. When he initiated a position, he did so with a clear thesis, an expectation of how the stock should behave. If the market failed to confirm his judgment almost immediately, he did not hesitate. He did not wait for hope to blossom, nor did he give the trade time to work itself out. He exited instantly and without emotion. He learned this brutal lesson during his transition from the bucket shops, where he could move with lightning speed, to the slower, more deliberate world of the New York Stock Exchange. In his early days, he would lose his entire stake because the game was different. The execution was slower and a lagging tape could be fatal. This taught him that any position that did not show a profit right from the start was a position that was likely wrong. If you make a trade and the stock immediately goes against you, it is a clear signal that your timing is off, and to remain in the trade is to substitute blind hope for sound judgment. The average speculator, upon seeing his first trade show a loss, is tempted to do the single most ruinous thing possible: average down. He buys another 100 shares at a lower price, believing he is improving his average cost. Livermore saw this for what it was, a fool's errand, the act of throwing good money after bad. He was adamant on this point: never average losses. To do so is to compound an initial error, to double down on a mistaken premise, and to transform a small, manageable loss into a catastrophic one. It is an admission that hope has replaced analysis. The market itself provides the ultimate verdict on your decision. If a stock does not act as you anticipated, the time is not yet ripe for the move. To argue with the tape is a form of vanity that no speculator can afford. The market is never wrong. Opinions often are. When you enter a position, you are testing a hypothesis. If the market's reaction is contrary to your expectation, your hypothesis is, for the moment, incorrect. The intelligent course of action is not to argue, but to accept the market's judgment and exit. The opportunity will still be there a few days or weeks later if the premise was sound, but the timing was premature. This rule is fundamentally a psychological one. It is the conscious decision to value your capital over your ego. The pain of taking a small loss is insignificant compared to the soul-crushing damage of a major drawdown. Livermore's genius was in his ability to divorce his emotions from his operations. He understood the treacherous interplay of hope and fear, recognizing that they become confused and inverted in the mind of the typical trader. When a trade goes against you, you hope it will turn around. When it goes for you, you fear the profit will vanish. Livermore's first selling rule was the complete opposite. He acted on fear when he had a loss, and on hope when he had a profit. If a stock dropped after he bought it, he became fearful that the loss could grow exponentially, so he cut it immediately. Conversely, if it showed a quick profit, he became hopeful that this was the beginning of a major move and had the courage to stay with it. This simple inversion of natural human emotion is the cornerstone of all successful speculation. Profits, he famously stated, can take care of themselves, but losses never do. The second rule of selling is a masterclass in patience and observation, a direct refutation of the amateur's desire to capture every last point of a move. Livermore was emphatic that one should never try to sell at the absolute top. Such an ambition is not only foolish but financially ruinous. The last eighth of a move, he noted, has cost speculators enough millions to build a highway across the continent. Instead of trying to pinpoint the peak, the wise speculator waits for the market to signal that the move has concluded. This signal often comes after a period of what he termed a normal reaction. In a strong upward trend, a stock will advance for a period and then experience a natural pullback on lower volume. This is a healthy and expected part of any sustained move. It is a moment for the market to catch its breath before resuming its primary course. A speculator should never be afraid of this normal movement. In fact, he should welcome it as confirmation of the trend's strength. The danger signal, however, appears in what happens after this reaction has run its course. If, following a normal reaction, the stock fails to rally and push into new high territory, it is a flashing red light. This failure to resume the advance indicates that the buying power that drove the initial trend has exhausted itself. The force of the movement has dissipated. When this occurs, the line of least resistance is no longer upward. It may be sideways, or, more ominously, it may have shifted to downward. To remain long in such a stock is to ignore a clear warning that the bull phase for that security is over. This is the moment to sell. This rule demands a profound level of patience. Having ridden a stock for a significant profit, the temptation to snatch that profit at the first sign of a reversal is immense. Livermore, however, learned from old masters like Partridge, the man he nicknamed Turkey, that the big money was never in the individual fluctuations, but in the great sweeping movements of the market. To capture these big swings, one had to have the courage to sit tight through minor reactions, to maintain one's position. This meant giving the stock room to breathe and the trend time to mature. But patience should not be confused with blind stubbornness. The moment a stock's behavior deviates from the established pattern of a healthy trend, advance, normal reaction, new advance, the speculator must be alert. If the rally after the reaction is feeble, or if it fails to materialize at all, the reason for holding the stock has vanished. The game is no longer to buy and hold, the game is to sell and exit. This is not a matter of opinion or guesswork. It is a direct interpretation of the market's own language, a message written clearly on the tape for all who have the discipline to read it. The third pillar of Livermore's exit strategy was his revolutionary concept of pivotal points. This was a more technical, almost mathematical approach to identifying the precise moments when a trend was either beginning, continuing, or most critically for our purposes, ending. He discovered that in the business of speculation, nothing new ever occurs. Price movements are simply repetitions of the past. By meticulously keeping records, he began to see patterns form, and he merged this with the critical component of the time element. His records, he said, began to talk to him. A pivotal point in his system is a significant price level that, once crossed, is expected to lead to a swift and sustained continuation of the move. He first observed this phenomenon with stocks crossing landmark figures like $100, $200, or $300. He famously traded Anaconda on this principle, buying it the instant it crossed $100 and riding a massive advance. He repeated the play when it crossed $200. These points acted as psychological gateways. Breaking through them unleashed a new wave of buying power. The key, however, was in the follow-through. The sell signal came when a stock crossed a pivotal point but failed to perform as it should have. His final trade in Anaconda illustrates this perfectly. When it crossed $300, instead of launching into another powerful surge, it only managed to crawl to $302.75 before faltering. Instead of the stock being difficult to buy, the market was being supplied with large quantities of it. This abnormal action was a clear danger signal. The vitality was gone. The follow-through was absent. Livermore didn't argue or wait for confirmation. He immediately sold his entire line, narrowly escaping a catastrophic collapse that followed shortly after. He refined this concept into a precise rule for confirming the end of a trend. After an advance, a stock would have a natural reaction. The low point of this reaction and the high point of the preceding advance would establish two new pivotal points. The stock was then expected to trade between these points. For the upward trend to resume in earnest, the stock would not only have to rally but decisively pierce the upper pivotal point by a margin of at least 3 points, or 6 points for his composite key price of market leaders. Failure to do so was a sign of weakness. The ultimate sell signal, however, was a break of the lower pivotal point. If the stock, after failing to make a new high, reacted and sold 3 or more points below the low of its last natural reaction, it was a definitive indication that the upward trend was over. This was not a guess. It was a mechanically generated signal from his carefully maintained records. It told him that the path of least resistance had irrevocably shifted downwards. This rule removed all emotion and opinion from the decision. The numbers spoke, and he obeyed. It was this systematic approach that allowed him to act with certainty and precision at the most critical turning points in the market. It is at this point in the journey where the mechanical rules meet the harsh reality of market pressure that many traders falter. The discipline to act on these signals, to trust the system over the siren song of hope, is often the missing ingredient. We created this channel not just to share knowledge, but to build a community of traders who understand this struggle. If you find value in these principles, subscribe to the channel and hit the notification bell. Return to this video or explore our others, not just for new insights, but as a place to refocus your mindset, especially after a series of losing trades. It is in those moments of doubt that a reminder of these foundational rules is most powerful. The fourth rule is the very heart of Livermore's trading essence, the unwavering discipline of tape reading to determine the line of least resistance. He viewed speculation as nothing more than anticipating coming movements, and to do this correctly, one must have a definite basis for that anticipation. For him, that basis was never an opinion, a rumor, or a fundamental analysis alone. It was the clear, unambiguous message of the tape itself. The tape, he believed, was the speculator's telescope, allowing him to see the battle between buyers and sellers in real time. His final judgment rested on one simple question: which side is winning? He asserted that prices, like everything else, move along the line of least resistance. They will do whatever comes easiest. If there is less resistance to an advance than to a decline, prices will go up, and vice versa. The art of tape reading was the art of determining this line. A sell signal was generated the instant he perceived that it had become easier for a stock to go down than to go up. This perception was not a mystical feeling. It was a conclusion drawn from the character of the transactions printing on the tape. For example, after a long advance, if a stock meets with heavy selling every time it attempts to make a new high, and if the volume on the subsequent reactions increases while the volume on the rallies decreases, the message is clear. The upward momentum is exhausted. The buying power that once effortlessly absorbed all offerings is now gone. The sellers are gaining the upper hand. The line of least resistance is shifting. To see this and not act is to commit speculative suicide. One of his core tenets was that one must not be too anxious to get into a trade, but instead, wait and watch the action of the stock market-wise. This rule requires absolute subordination of one's ego to the market's reality. A speculator might have a perfectly logical, well-researched opinion that a stock should be worth more. But if the tape shows persistent selling and a clear downward pressure, the tape is right and the opinion is wrong. To get sore at the market doesn't get you anywhere, he would say. To argue with the tape is futile. It does not go into explanations. Its business is now, not tomorrow. The reason for a stock's behavior might not be known for days or weeks, but the trader must act instantly or be left behind. Livermore demonstrated this principle countless times. He would be bullish and long of a stock, but if he saw the character of the buying change, if he saw support vanish and sellers gain control, he would sell out his entire line in a flash and often go short immediately. This was not indecision. It was the highest form of discipline. It was the recognition that his job was not to be loyal to a position, but to be on the right side of the market at all times. The tape was his commander-in-chief, and its orders were to be obeyed without question. The fifth rule reveals the mindset of the true professional, a principle governing the distribution of a large line of stock that is completely alien to the average trader. The amateur dreams of selling at the highest possible price on the ticker. The professional, Livermore understood, must sell when he can. That is, when there is a market to absorb his holdings. This opportunity for liquidation, this window of liquidity, almost always appears near the end of a major move, during the final frantic burst of public buying. A large part of any major market move, he observed, occurs in the last 48 hours of the play. This is the stage when the public, which had been skeptical during the quiet accumulation and the steady early advance, finally succumbs to the mania. The news is universally bullish, the tips are flying, and stories of fortunes being made are on every lip. This mass excitement creates an enormous buying power, a market that can absorb tens of thousands of shares without caving in. This, for the large operator, is the signal not to buy more, but to begin selling. The goal is to convert a massive paper profit into real cash with the least possible slippage. You cannot expect the market to absorb 50,000 shares as easily as it does 100. Therefore, the manipulator or large speculator must patiently wait for the requisite buying power to materialize. He has to sell when he can, not when he wants to. This means selling into a strong, active, and rising market. It is the exact opposite of what the public is doing. The public is buying into the excitement. The professional is selling to them. This process is not a single dramatic act, but a campaign of distribution. As he explained in the context of manipulation, the principal marketing of a stock is often done on the way down from the top. After marking a stock up to its highest possible point, the selling begins. The public, conditioned by the long advance, eagerly buys on the first reactions, viewing them as bargain opportunities. This demand from bargain hunters and short covering from traders provides the liquidity needed for the professional to unload the bulk of his line. Livermore's own actions mirrored this logic. When he had a large profit in a major bull or bear move, he did not wait for the final tick. He began looking for the market that would allow him to turn around, a market with enough volume and excitement to absorb his holdings. He saw the final explosive phase of a move not as a reason for more greed, but as his heaven-sent opportunity to get out. This is the professional's mindset. His job is not just to be right, but to cash in on being right. The sixth and final rule is a simple mechanical system for protecting profits while pyramiding a position, a method so effective in its discipline that Livermore immortalized its practitioner, a trader named Pat Hearn. Hearn, a professional gambler, approached the market not with hopes of long shots, but with a system designed to secure sure money. He understood that the key to winning was not in the brilliance of his entries, but in the ruthless efficiency of his exits, particularly when managing a position built upon earlier profits. Hearn's strategy was methodical. He would begin by buying a small lot, say 100 shares. If and only if that first purchase showed him a profit, for instance by advancing 1%, would he buy another 100 shares? He would continue this process, adding to his line on a rising scale, never buying more unless the previous purchase was profitable. He was pyramiding his position, but only on the market's confirmation that he was correct. This ensured his big bets were only placed when he was winning. The true genius of the system, however, was in its stop-loss mechanism. For every new lot he purchased, he would immediately place a stop-loss order just 1 point below the price of that most recent purchase. As the stock continued to rise and he continued to add to his line, he would move his stop up accordingly, always keeping it 1 point below his last entry. This created a trailing stop that protected not just his initial capital, but the vast majority of his accumulated paper profits. This method accomplishes two critical things. First, it makes it impossible to suffer a large loss on the entire position. A 1% reaction would stop him out, but his loss would be minimal, confined to a small drop on his last purchase while preserving the gains from all the earlier ones. Second, it automates the decision-making process, removing the destructive emotions of hope and fear from the equation. There was no agonizing over whether a reaction was temporary or the start of a major reversal. The rule was mechanical and absolute. Lefebvre contrasts this with the story of a trader named Roberts, who, after successfully using Hearn's system to make a fortune, abandoned it out of overconfidence. When a reaction came, instead of cutting his loss as the system demanded, he held on, listening to hope's whispers. He was wiped out completely. This cautionary tale serves as a stark reminder. A system is only effective if it is followed without deviation. Pat Hearn's 1-point stop rule was the ultimate expression of trading discipline, a simple, logical method for letting profits run while ensuring they never ran away.